The Nuburu Inc. BURU stock is currently trading at $0.35 per share, reflecting a marginal dip of minus 0.006 or minus 1.70% in intraday movement as of the most recent data point. The market is clearly digesting a period of intense, almost unbelievable volatility for this stock. Now, what you might expect from a name trading for cents on the dollar is just the typical, quiet penny stock drift, but the reality is far more complex and, frankly, aggressive. The low stock price masks a complete strategic upheaval, a massive business model pivot that has seen this blue laser technology firm suddenly become a hotbed of defense and security-related acquisition news. Just look at the trading volume. The 30-day average volume for BURU is colossal, which tells you that speculation and short-term trading dynamics, rather than quiet institutional accumulation, are driving this stock. The recent news cycle, involving a flurry of announcements around defense acquisitions and a strategic joint venture for drone development, has acted like an adrenaline shot, temporarily spiking the stock and creating dramatic, whiplash-inducing swings. This isn't a slow burn. It's a high-stakes, high-velocity trade right now. The common ground narrative for Nuburu Inc. is straightforward. It's a fascinating, deeply speculative microcap company that holds patented blue laser technology, a potentially significant advance for welding and additive manufacturing, especially for metals like copper and aluminum, which have poor absorption of traditional infrared lasers. The promise here is faster, cleaner, higher quality welds for high-growth sectors like electric vehicle batteries and next-gen 3D printing. The expectation is that the technology is genuinely groundbreaking, but the reality, until very recently, was a consistent struggle for commercial traction, resulting in minuscule revenue and significant net losses. The stock was for a long time stuck in the purgatory of an exciting but commercially immature deep tech play. The deeper take, the contrarian view that forces a rethink, is that the blue laser business is almost secondary now. The entire investment thesis has shifted from a deep tech laser company that might find a market to a defense and security holdings company that happens to own a blue laser unit. The market isn't trading on the efficiency of the AO-150 blue industrial laser anymore. It's trading on the geopolitical and strategic value of the newly formed Nuburu Defense LLC and its acquisition targets. This pivot creates a huge tension. Are the recent stock spikes a valid repricing based on a new high-growth, high-margin defense thesis, or are they a temporary speculative bubble fueled by retail traders flocking to an easy-to-move stock on the back of tantalizing headlines? The institutional ownership is still extremely low, less than 1% of shares outstanding, a figure that highlights the speculative nature of the current activity, and suggests that large players are either waiting for more concrete financial results from the new defense ventures or are simply avoiding the volatility of a sub-$1 stock undergoing such a fundamental transformation. Looking closely at the recent stock movement, the spikes are undeniably tied to the defense news. The stock experienced a massive surge following the announcement of a binding agreement to acquire an Italian software firm, Orbit SRL, which specializes in operational resilience solutions for the defense sector. This news provided a clear direction and a potential source of immediate, though relatively small revenue compared to the scale of the past losses. Then, just days later, the stock jumped again on the announcement of a strategic alliance with Maddox Defense, creating a joint venture focused on next-generation drone technologies. This quick succession of defense-focused news created an immediate, strong sense of momentum. When you look at the daily charts, these news days are characterized by massive volume spikes, with tens and even hundreds of millions of shares trading hands, dwarfing the average. This frenzied activity is classic short-term trading. The high volume indicates a tug-of-war between aggressive buyers, betting on the strategic pivot, and short sellers/profit takers capitalizing on the extreme volatility. The stock price, oscillating between roughly $0.30 and $0.40 over a short period, shows that the market hasn't yet settled on a fair price for the new Nuburu. Every dip has been met with buying pressure, suggesting a persistent belief in the defense story, but the inability to hold higher price levels indicates significant selling resistance or simple profit-taking from those who bought the news. This is a tough trading environment, one that requires the kind of active, real-time platform access you get with tools like Fidelity's trading platform or Interactive Brokers' offerings, rather than a hands-off Schwab Intelligent Portfolio approach. The frequent filings related to the issuance of common stock to finance these new acquisitions, though necessary, also contribute to share dilution fears, which puts a constant pressure on the price, causing a quick retreat after a good news spike. The company is essentially using equity financing, a common practice for microcaps, to fund a massive strategic shift, and the market is having to price in both the potential upside of the acquisitions and the certainty of shareholder dilution. The background of Nuburu Inc. is its intellectual property in blue laser technology. Founded in 2015, the idea was to overcome the limitations of traditional industrial lasers, which are generally infrared. Blue light is absorbed much more effectively by common industrial metals like copper, gold, and aluminum, making the welding process up to 8 times faster and significantly improving quality by reducing defects like spatter. This is particularly relevant for the manufacturing of complex, lightweight components and for EV battery manufacturing, where precise, high-speed copper welding is absolutely essential. The core technology, the AO150 and the high-brightness Misaki lasers, are the company's original product line. The historical business model was straightforward. Sell and service these industrial laser systems and license the company's extensive patent portfolio, which boasts over 220 patents granted or pending. However, the path from patented technology to commercial success proved excruciatingly slow and capital-intensive. The company racked up over $130 million in net losses as of the last available annual figures, and commercial revenue was anemic, a stark reminder of the long adoption cycles in heavy industrial sectors. Past performance is a cautionary tale, a long, difficult struggle to scale the blue laser business, characterized by high cash burn and multiple compliance notices from the NYSEAMERICAN. The company's original high-growth thesis simply was not materializing quickly enough, forcing the radical transformation plan announced earlier in the year, which paved the way for the current pivot to the defense and security market. This context is essential. The recent stock volatility is less about a sudden breakthrough in the core laser business and entirely about the perceived value of the new, acquired defense assets. Online investing in a stock like this requires an understanding that you're essentially betting on a completely new management team executing a high-risk, high-reward turnaround strategy. Now, let's look at the future outlook through the lens of expectation versus reality. The expectation, driven by the headlines and the initial surges, is that the new defense and security hub is a magic bullet that will provide instant revenue and profitability. The reality is that while the target addressable markets like electronic warfare and operational resilience SaaS are massive, the company is starting from a near zero revenue base. The stated financial expectations from management, which include an anticipation of billings of approximately $500,000 in the fourth quarter of 2025 from the new defense operations, are a welcome sign, but they are a very modest starting point against the backdrop of historical quarterly losses that have often been in the multi-million-dollar range. The catalyst for continued stock movement will be the successful integration of the acquired entities like Orbit and the strategic alliance with Techne, and, crucially, the delivery of tangible revenue growth in 2026. Investors will be watching for the finalization of the acquisitions and the consolidation of the new businesses, as well as the progress in leveraging the blue laser technology for defense applications, which is the synergistic link between the old and new business models. The high expectations also carry significant risks. Firstly, there is the ongoing dilution risk, as the company will likely continue to rely on equity offerings to fund its acquisition-led growth strategy, which can be a heavy headwind for the stock price. Secondly, the company is still a microcap with significant operational challenges, including past compliance issues with the NYSE, which adds a layer of regulatory and operational risk. The company must sustain its recent compliance status and demonstrate a clear path to generating sufficient cash flow to cover its operations without constant reliance on new share issuances. For investors considering this stock for their individual brokerage account, the upside potential is huge if the defense pivot works, essentially turning a failed laser company into a successful defense contractor holding. But the downside risk is equally pronounced, as the failure of the acquisitions to deliver revenue could send the stock back to its previous depressed levels. The tension here is maximum. The high expectation of a successful pivot into the lucrative defense space is directly challenged by the reality of a financially fragile company attempting a difficult, complex, and capital-intensive transformation. It's a high-wire act. Before we wrap up this deep investment discussion, I want to drive some engagement. Comment below how many shares of Nuburu, BURU you currently hold, or if you think the defense pivot is a stroke of genius or a